Right now, around 1.6 million homeowners in the UK are walking straight into a financial storm. Most of them don't know it. They're living their lives, paying their bills, doing everything they can to keep up, but something is coming in 2026. And the scale of it will hit harder than anything we have seen since 2008. The fixed-rate mortgage deals that people locked in during the pandemic are reaching the end of their term. Back then, lenders were offering rates below 2%. Some deals started with a zero. It felt safe. It felt sensible. It felt like a good move at the time. But those deals are ending in 2026. And when they end, people won't be returning to those comfortable numbers. They'll be facing a jump of hundreds of pounds a month. For many households, the increase won't just hurt. It will break them. This isn't a forecast. It's not speculation. It is baked into the system. The 2026 mortgage shock is already on its way. In this video, we're going to break down what's happening, why it's happening, who it hits first, how it spreads, and what the next 12 to 18 months actually look like. This is the property lens. Clear explanations, real consequences, no spin. Let's start with the basics. Between 2021 and 2022, the UK saw one of the busiest periods in mortgage history. People were rushing to buy while rates were low, house prices were climbing, and lenders were offering deals that looked almost too good to be true. 2-year fixes around 1%, 5-year fixes around 1.5%. Even high loan-to-value borrowers were getting deals that felt comfortable. But here's the problem. These deals don't last forever. Most of them end in 2026. When they end, those borrowers need a new rate. And the new rates are not 1 or 2%. They're 4 or 5 times higher. If you borrowed £250,000 at 1.3%, and you're now offered 5%, your payments could jump by £600 or £700 a month. Some households are looking at more than £1,000. That is mortgage shock. And it's not hitting a small number of people. It's hitting 1.6 million. This is where the story begins. But it's nowhere near where it ends. To understand the shock, you need to understand what pushed rates so high in the first place. Inflation exploded after the pandemic. Supply chains collapsed. Energy prices went through the roof. The Bank of England responded by raising the base rate again and again. One rate rise after another. They weren't gentle, and they weren't slow. The goal was simple: bring inflation back down. But every rise pushed mortgage rates higher. Lenders began tightening their criteria. Affordability checks became tougher. Stress tests became harder to pass. The safety margin that banks require grew. This is why refinancing isn't just more expensive, it's also more difficult. Some people won't qualify for a new deal at all, especially if their income hasn't kept up, especially if they borrowed at a high loan-to-value, especially if their house price has dipped and they are closer to negative equity. The system is squeezing from both ends. Higher rates on one side, tighter lending rules on the other. For many households, that's a dangerous combination. The first group to feel the impact is the people who fixed at the start of 2021. These were the homeowners who jumped early when rates were at their lowest. They're the first wave. Many of these buyers stretched themselves. They bought right up to the edge of what the bank allowed. They could afford it then. They may not be able to afford it now. First-time buyers are especially vulnerable. Lots of them took out 90 or 95% mortgages. They bought at the top of the market. They borrowed a lot relative to their income. Now, with prices flat or falling, they might be close to negative equity. Families in the southeast sit in another danger zone. Higher house prices mean higher borrowing. Higher borrowing means bigger payment jumps. A 5% rate on a large mortgage hits like a hammer. But here's the important part. Mortgage shock doesn't stay contained. It spreads. As the year moves on, more and more deals come to an end. More people start to struggle. More households fall into arrears. The pressure builds, and once enough households are struggling, the wider market starts to shift. When thousands of people can't afford their new mortgage payment, the first sign is a rise in missed payments. Not huge numbers at first, just a slight uptick. But lenders notice. Then you start seeing houses being listed by people who don't really want to move. They're not upgrading. They're not relocating. They're trying to avoid sinking. Forced selling isn't dramatic. It doesn't look like a queue outside an estate agent. It's quiet. It's individual households making tough decisions at the kitchen table. But once enough people are forced to sell, prices begin to soften. Not crash, not collapse, but soften. And that softening creates a feedback loop. If prices slip by even a few percent, more people fall into negative equity. When they fall into negative equity, they can't remortgage easily. If they can't remortgage, they're stuck on higher rates. If they're stuck on higher rates, their payments rise again. This is how a mortgage shock turns into a housing cycle. Meanwhile, landlords are leaving the market at increasing speed. New regulations, new rules, higher taxes. Combine all of that with higher mortgage costs, and many landlords are selling up. When landlords sell, renters face tighter supply. And when supply tightens, rents rise. Not because landlords are greedy, because the system is shrinking. So now we have renters squeezed, homeowners squeezed, landlords squeezed, and household budgets breaking down across the country. This is the environment the government walks into during an election year, and that makes things even more chaotic. Let's look ahead. January to March 2026. The first wave hits. Early 2021 fixes expire. People start calling their lenders. New payments land on their statements. Confusion rises. News stories begin to appear. Nothing dramatic yet, just tension. April to June 2026. Arrears begin to rise. This is the period where lenders feel it first. Some households fail affordability checks. Some are offered rates they simply can't handle. Estate agents start to see more forced listings. July to September 2026. This is the strain point. More than half of the expiring deals roll through this period. The pressure spreads into the wider economy. Consumer spending tightens. Rents continue rising. Landlord exits increase. Political pressure hits boiling point. October to December 2026. If the government hasn't acted by this point, they have no choice. Housing becomes the top election issue. Both major parties release new proposals. Some are rushed. Some are unrealistic. Some could make things worse. By the end of the year, the mortgage shock becomes a national conversation. Not background noise. Not an economic data point. A real living crisis, felt in homes across the UK. This is the world we are heading into. And most households are not prepared for it. Let's talk about what happens now. Rates are not dropping back to 1 or 2%. Not soon. The old world is gone. Even if inflation falls, the Bank of England wants stability. They don't want to cut too fast and repeat the cycle. House prices won't soar. They won't collapse either. What we're likely to see is a slow grind downward. A market that doesn't move much. A market that feels stuck. Renters will face more competition. Not because landlords want higher rents, but because fewer properties are available. The system pushes rents upward, even when no one wants that outcome. Homeowners will have tough choices to make, paying the higher rate, extending the mortgage term, switching products, tightening their budgets. Many will manage, some will not. The big question is what the government chooses to do. Will they intervene? Will they offer support? Will they adjust the rules? We will see a lot of promises in 2026. Some are helpful. Some are meaningless. Your best defense is understanding. Knowing what is coming. Knowing why it's happening. And knowing how the pieces fit together. That's what this channel is here for. If you found this breakdown helpful, the next video will give you a clearer picture of how the UK housing crisis is developing and what you should expect next. This is the Property Lens. Thanks for watching.